Hey, what's up YouTube? This is Foxtail Digital coming to you again with Black Girl Stocks. Now this video is going to be about unlocking the hidden power of risk management. You've probably heard in trading, it's not the money you make, but the money that you keep. And you'd be surprised. It's something that even experienced traders can sometimes overlook or forget about. This video is going to be a deep dive into risk management. So whether you're trading for a little bit of extra cash or you're investing full time, our goal is going to be the same: to trade without burning out after a few losses, and to ultimately keep trading. Not just making money, but also not losing too much of it is the key. So we're going over everything from figuring out how much to trade or position sizing, and how to set your stop losses just right for every single trade. Plus, I'm going to stress how keeping a cool head and controlling your gut emotions is just as important as any trading strategy that we talk about. All right, so let's get into how proper risk management can save and make you money for a long and profitable trading career. But first things first, 4 golden rules of risk management come into play. 1, think about protecting your capital first, then the profits. Your trading life depends on it. 2, don't let a large profit turn into a small profit. That's the golden rule of profits. 3, a small gain is better than a loss, and don't let greed tell you otherwise. And 4, never let a small loss turn into a large loss. So you want to minimize your losses before they turn into big ones. So the first question is, why is risk management so important anyway? Okay, so I'm going to show you a chart that visualizes how deep the hole can get with losses and the effort that it takes to get out of that loss. So imagine this: you're in a trade and things start to go south. It happens. To get back to where you started, a 1% loss is easy to recover from because it only takes 1% to get that back. But a 50% loss means that you have to double profits on that position just to break even. If you lose a certain percentage, then you have to gain a higher percentage to get back to your starting point. And the reason why is because after a loss, essentially your starting point for recovery is lower. So the same amount of dollars represents a larger percentage of your investment. Say you have an investment that's worth $100. If it loses 10% of its value, now it's worth $90. That's a $10 loss. So to get back to $100, you need to gain $10. But gaining $10 from $90, it's about 11.1% of an increase. That's not 10%. So this example alone shows that losing 10% means that you have to gain more than 10% to get back to where you started. And if you're anything like me, the next question that you're going to ask is, okay, well, in risk management, why are we so hung up on percentages instead of just flat dollar amounts? That's easy, because a 10% gain in a $500 account and a $5,000 account are hugely different as far as cash value, but they're essentially the same in growth. And if you're doing this for the long term, it's all about scaling up and comparing your performance in your trading and not getting so lost and caught up in the absolute numbers. That's whether you're trading with hundreds of dollars or thousands. A 10% gain is something to be proud of. Let's start with one of the easiest and most important aspects of risk management, and that's stop loss orders. And it's important that that's the first thing that you do before you get into any trade. You want to know where your stop loss is going to be. Remember our first golden rule: think about protecting your capital first, then the profits. And this is before we've even thought about potential profits or where, the price could potentially go. I'm going to keep this really brief because it's going to play into the next topic. Okay, so imagine a stop loss order is protecting your capital. Its main purpose is to keep you from making a huge account blowing loss. And so when you put in a stop loss order, you're basically telling your broker to close your position once it hits a certain price. The 2 most effective ways that you can set stop losses are going to be either basing them on the volatility of the individual asset that you're trading, or aligning it with important chart levels like support and resistance. Setting your stop loss one of these 2 ways is better than a one-size-fits-all percentage, like cutting your losses at 20% for every trade. And somebody just mentioned this in my options trading group yesterday. They said, if I have a 30-day expiration date and my stop loss hit a few minutes after applying the trade, should I execute, meaning follow through with the stop loss, or should I let it ride out, meaning hold on to the position? And so basically I just kind of told them, about whether or not they should stay in that position. And then the next question that I asked them was, okay, well, what strategy did you use to set your stop loss? And they said I typically set it at 10%, but that's going to depend on the amount of contracts that I'm using. You can kind of see from this example, real time, where this problem can come into play, getting kicked out of your positions too early. So let's talk about using volatility to set your stop losses. When you set a stop loss based on volatility, then you're basically taking into consideration the average price movement of whatever asset that you're trading over a given period of time. And so an indicator that I like to use is the average true range, or the ATR. And this indicator basically calculates how volatile the price movement is. And that's how much the price is moving in between different highs and lows based on what's been happening in the market. And usually the average true range is going to be set according to 14 periods of whatever chart time frame that you're looking into. So that could be days, it could be weeks, or it could even be minutes for short-term analysis. For example, if the average true range, or the ATR, shows a value of 2 on a 5-minute chart, then that means that the average price movement from high to low is about $2 every 5 minutes. That's going to show you how volatile it is. One practical strategy that a lot of people do is they set their stop loss at 1 to 3 times the average true range. They're going to take the average true range, multiply it by that, you would call it a multiplier. You would put that below wherever the current price is or the entry price. And so depending on how normal or volatile you expect the price to be. So if you're expecting normal volatility, you can use 1.5 as the multiplier. Or if you need something a little bit more tight, then you would want your stop loss to be 1 times the average true range. And that'll kind of minimize your risk. And when you look at the actual indicator line, if you see that the average true range line is higher, then that means that there's more volatility and larger price swings. So you may want to use a higher multiplier, like 2 times or 3 times, to keep your trades at a safer distance from, all that wild price action. And on the opposite, if you see a lower average true range line, then that means that the market is less volatile and you're going to have smaller price movements. So here you can use a stop loss that's a little bit more lenient, maybe something like 1.5. And then you're not going to be as worried about getting kicked out of your trades early. Let's look at your actual stop loss formula. So your stop loss is going to be the current price, or either your entry price, minus your multiplier times the average true range value. So for example, let's say that you're looking at a potential pullback trade. Let's show how you would set your stop loss using volatility. Right now, if the price is at $100 and the average true range is at 2, and then we chose a 1.5 multiplier, we're going to set our stop loss at 1.5 times where the average true range is below the current price. And so that would look like a stop loss level of $100 minus 1.5 times $2. So that would be $97. That's where we would have our stop loss. So that gives us about $3 worth of room. That's not that bad. And so this strategy helps us take advantage of the actual volatility of the price, and it gives us more room for the price to move. Now let's talk about using chart levels to set your stop losses. Now the second way that you can set your stop loss is pretty straightforward, and that's going to be based on the chart levels, like we said, the support and resistance. If you know about support and resistance levels, you know that these are really important because they highlight areas on the chart where we could have a potential shift in the market momentum. Once you see those consolidation areas, they're really good places to have your stop losses. All right, now looking at that same potential pullback trade, let's show how to set a stop loss using chart level method. Now imagine that same chart is in a pullback towards a support level at $98. We're still looking for it to have a bullish move, but just in case, to protect our trade and at the same time give it space to breathe, then you could set your stop loss just below that support level. So say maybe 97, 96, 96.50. So setting your stop loss here considers that if that support level breaks, we can end up taking a smaller loss versus a trend reversal or a further pullback. Using these strategies is things like customizing your stop loss orders to however wild or calm the markets are at that particular time. I feel like we have another video that talks about stop loss orders for options that I actually would like to do an updated video on, but I don't know exactly if we got into these specific topics. There's a few different types of stop losses that I want you to be aware of. The three main ones that you're going to see are standard stop losses, trailing stop losses, and stop limit orders. The standard stop loss, this is going to be your safety net that we talked about. If the price falls to a certain level, then it's going to cut your loss automatically at that price. Then you have the trailing stop loss order, and these basically adjust your stop loss with the moving price. Okay, so it's going to stay a certain percentage below the peak of your profits, and they're going to go up with the market, but it's going to stay put if it starts to drop. Honestly, I feel like it maximizes your profits and you don't have to be sitting at the screen. The stop limit order, I feel like a lot of people get a little hung up with this one. It's basically like a combination order. You have a set trigger price, and if that price gets hit, then the system is going to go into play, and it's going to attempt to sell your order at that limit price or better. It's going to give you a better shot at getting out of that trade. It's not a market order though, so it could completely get passed up depending on how volatile it is at that time. And you can choose based on, your specific styles. If you want something simple, stick with the standard. If you really want to protect your profits, go with the trailing stop loss. If you are really hung up on price, then use stop limit. Getting back into how much you're actually going to risk per trade. Now this is going to be the grand question. How much or how many of these shares, contracts, coins can you buy? Now this is interesting. You know your account size, and now we know our risk percentage. And I want to show you this chart here that you can actually make for yourself about how much you would risk of your account per trade. Okay, so I have from 1 to 10. Okay, so this takes into account different account sizes: a $1,000 account, a $5,000 account, $10,000, $25,000. You can pick and choose your particular percentage that you're comfortable risking per trade. Usually they say somewhere from 1 to 10%. So just for example, if you had a $5,000 account and you're risking 6% per trade, that would be $300. That's not that bad for a $5,000 account. So that's just kind of something to keep into consideration. Now let's go over different ways that you can figure out how much of a trade that you should take on. And this is where we get into position sizing. The reason I'm actually making this video, this came from one of the comments that one of you guys left, but the question was about the position sizing tool video that we posted and how to tailor your risk management. So when we talk about position sizing in trading, that's the amount of money that you're going to use towards any single trade. If you put too much in, it's going to be harder to hold on to that position without losing too much. And at the same time, if you don't put in enough, then you could get watered down results. If we don't have a system, then you're going to see a lot of fluctuation. You're going to see one trade you may lose $100, another trade you may lose $500, $1,000. So, you kind of want to have it a little bit more consistent to your account. This is what's going to build your confidence while you're trading. These percentages that we talked about, they work because the market is always changing. Not every trade is going to be the same, and we're all different. The most straightforward and popular position sizing method is called the fixed percentage position sizing model. And the idea is to risk a fixed percentage of your total capital. For example, so like we said, the 6% or even 5%, let's do 5% for each trade. So let's say, for example, we wanted to buy an Apple 125 strike price call option that expires in 30 days. And the premium is about $105, so 1.05. We have a $2,000 account, and the next thing that we can do is calculate our risk per trade. So first we want to calculate the total amount of your account that you're willing to lose per trade. And that's going to be based on that 5% risk that we talked about. So your risk per trade is going to be $2,000 times 5%. That's $100. The next thing is to find the stop loss for your trade per contract. We want to know the risk that we're going to take per unit, or in this case, per contract. So the risk per contract is going to be our entry price minus our stop loss. loss. Like we said, remember, one option contract is 1.20 or $120. Based on our option contract chart, we decided to set our stop loss where the value of the option premium drop would be $100 from the original purchase price. And so once it dropped to that, we would exit that trade. So based on our stop loss, the most that we would lose on this position is $20 per contract. The next thing is going to be calculating the position size based on our risk tolerance and our stop loss. And here's your equation. Your position size, or your number of contracts that you can buy, is going to be your risk per trade based on your account size divided by the risk per contract based on our stop loss. Our total risk amount per trade is $100, and the stop loss distance, or the risk per contract, is $20. And so you can use this to measure how many contracts that you can buy without risking too much of your account with that stop loss. So that's going to be $100 divided by $20, which is 5. Safely, you can buy 5 of these contracts and set a stop loss order at 1.00 for the premium. And so you're spending about $600 on this position and ultimately risking $100 of your account, or that 5%. Okay, so that's what the benefit of sizing your positions this way is going to be, because it helps you grow your account and trade larger positions as you get better, as you get more confident. And speaking of confident, the last thing that we're going to talk about, and it's going to be really brief, is psychology and discipline. Okay, so how do we even stay emotionally stable enough to follow through with these plans? It does take discipline to, 1, even create your trading plans, and then 2, follow through with it. The 2 main emotions that you're going to feel when you're trading are fear and greed. Greed is going to keep you from taking your profits on a profitable trade, and fear is going to keep you in a losing trade for too long. So when you let these emotions drive your trading decisions, then that can definitely turn profitable trades into losses. And if you remember our 4 rules, what rule was that? Never let a profitable trade turn into a loss. The number 1 way to control your emotions while you're trading is to have that detailed trading plan for every single trade and stick to it. So you know your entry price, you know your profit target, and you know where you're going to set your stop loss. You already took the time to logically plan that trade, so don't let your emotions move you. You might be thinking, okay, well, what if I exit the trade too early and you miss out on profits? The answer to that is just make more profitable trades more often. Take less losses. Grow your portfolio. It really can be that simple. It really can. So when you do have a strategy and a clear exit plan, then you're going to see more winning trades. You're going to have smaller losses, and you're going to make less emotional decisions when you trade. All right, so that's it for today's video. And that was just a brief look into how you can protect your portfolio for the long run. The learning doesn't stop here. I really need your help to continue our journey here on the channel. I know it's been a little stagnant, but what's next? Okay, so I have a few powerful topics in mind, but it's going to be up to you which one that you see first. Okay, so please head over to the community tab and vote on which video you want to see next, so you can help shape the future of our content. And also, if you have a topic that's completely different that you want to talk about, please leave it in the comment section below. If you found this video helpful, please make sure that you click that thumbs up button for me. It really helps the channel. Also, subscribe and click that notification bell so that you get notified anytime I upload a new video for you guys. All right, now I'll catch you on the next one.